Welcome back, traders. It's 2026 and ICT is back with more lectures, videos, and live streams. Now, I wasn't actually expecting ICT to be back so soon, but it goes to show you can't trust ICT when he says stuff like, I'll be back in February. You know, social media, regardless of what he says, is his mistress, and he just can't stay away for very long. But that's all good for us because that gives us more material to study. So we're going to go ahead and take a look at this video that he posted on New Year's Day called From Vision to Execution, which can sound a little grim if you take it the wrong way, but the purpose of this video is to try and give you some ideas on how to predict future price action. You know, getting you to have a vision on where price is likely to go to next. Now, as usual, I will be skipping over all the ranting and the motivational speeches and just sticking with the technicals. But if you like that kind of stuff, I will have the original video linked so you can go ahead and watch that 1 hour long video yourself. Now, I know you guys like these kind of videos, so please help me out by giving this video a like and make sure to subscribe because I know I'm a little late on this one, but as soon as another ICT video comes out, I'm going to try and get it on right away. Anyways, thank you very much, and let's get this one started.
So I'm going to show you this here. This is Tuesday, December 23rd, 2025. 1 minute candlestick at 9:54 a.m. Now, why am I picking that one? Well, what you're looking at is a pair block run right out from Jump Street. So at 9:30 in the morning, they just ran it straight from there. Created a short-term high, rallied above it, false break above that, and turtle souped it right back down into the initial run. That shift right there, below the swing low in here, that displacement is significant. Go back over your NASDAQ chart and you'll see that this short-term run here stands out on your chart. So when I'm looking at price action where price has been made jagged, like it does here, I don't need it to take out that low. I just need it to show me these types of fair value gaps. So when they stand out in price action where price has had a turtle soup, a major displacement, or it just leaps out at the chart. Zooming out, not zooming in tighter, okay? By zooming out, your eye will jump right to these types of swing highs and swing lows. And when these runs are occurring, there's lots of manipulation in that. And you're going to be best served by going in and looking for these types of imbalances when they first form. Notice there's no fair value gap here until that, after it took that high. So this IPDA array is first presented fair value gap after turtle soup. The first fair value gap that forms after that, keep that on your chart. Project that forward. Think about the IPDA ranges. What's the lowest one? 20 days. Keep it on your chart for 20 days. That's why this is still valuable to me. I already know this is going to be a viable level in the future. Now I just simply have to wait for time to agree and meet with that price.
So first, notice this chart depicts December 23rd. This is going to be the Tuesday of the previous week that we're talking about. He says to keep this on your chart for 20 days. Well, you know, it can get kind of messy and confusing if you have a lot on your charts. So I recommend saving these on a separate drawing set if you can, or jot it down in a notebook. And if you want to review the lecture on IPDA ranges, you know, the 20, 40, 60 days, check out the core content month 5. I also have a quick 10-minute AI video on it as well. I'll put that in the link in the description. But real quick, before we move on, this actually looks like the model 2022 to me. We have a sweep of liquidity, a market structure shift with displacement. However, price never came back up for an entry until around 1040. But at this point, I wouldn't be eager to short here since we had already dropped a lot. Also, if I remember correctly, I believe I was bullish on my higher time frame here, so I would be very cautious to short anyways. So remember, anytime you want to trade against your higher time frame bias, you need to be extra cautious.
Well, that's the high that run.
So this is 1 week later on Tuesday, December 30th.
So that's the market reaction there. Now, right away, you should know the opposite of that. It was a nice little rally all the way up in here, and overnight, here's your lows. So cast forth a vision. If it's running quickly up to that level and it proves to you it doesn't want to stay there, it starts to sell off. And then we're entering the time of day when we're looking for the opening range, 9:30 in the morning Eastern time to 10 o'clock. We're looking for that first presented fair value gap. That's that right there. Now, right away, you can see it's using it here and here. And where do you think it's drawing to? Before this even formed, before 930 even happened, while it's dropping down, in your mind, you're going to cast forth a vision. This is what I do. I'm looking at the market and I'm casting forth a vision. I'm waiting for a price run that creates a long, protracted down closed candle. I'm waiting for that to form. I'm anticipating that to form. Because I know all of this reaction from this run here is likely to see us go all the way back down to take overnight lows. That's the draw. Now, the easiest way for you to have this on your chart or a routine is overnight lows. Just simply mark off midnight Eastern time to 7 o'clock in the morning. Whatever the lowest low there is, if it's relative equal lows, that's a loaded deal. That's where liquidity is. It's going to want to seek that if it's bearish. Not all the time, not that very day, but that's how I classify it. I'm looking for that lowest low overnight. In this case, we can see it being here. So that's a relative equal low. So you can see that that's obviously a standout. That's your sell side liquidity. We have the displacement here. So that's the first percent of fair value gap after 930. And market uses it here and here. And then we start getting into this back and forth type price action. This is classic of the holiday season. Again, another reason why I'm not a fan of trading around this time. I'd rather spend the time with my family. In here, we're going to take a look at this. We're going to zoom in and deal a little bit more with this. But I want you to think about that level right there being these lows. That's the draw. So I'm casting forth a vision, or you would be casting forth a vision on how price would traverse from this first resistance fair value gap down to that low. When the majority of the run was accelerated, so half that run was real quick and sudden. And now it's a lot of give and take back and forth, reaching down into that sell side liquidity pool overnight. So we're going to focus in on that little area right there, and we're zooming in.
So overnight lows and highs should be easy to spot, but maybe sometimes you forget, or it doesn't look that clear to you. One trick I like to use is using the 1 hour chart to identify liquidity. There's less candles and it's just more clear, and it's very obvious to me where liquidity is. On the 1 minute chart here, you may see all these lows and think that this is where price will draw to, like right over here. Well, after taking these out, you can see that we did get a slight bounce, so it would have been a good place for a partial. This retracement here might scare you out. And you can also avoid all of these choppy actions right here before finally getting to the overnight lows. So even though liquidity is down here, it's important for me to find places to take partials to make it easier on me mentally. And the equal lows here is a good place to take a partial because it's also around equilibrium of this range.
The market creates the fair value gap. When this candle closes, it trades up into it here, and we're anticipating price reaching lower. The market drops down, comes right back up, trades to the low of the fair value gap. That's the first position fair value gap. We do not abandon the idea it's reaching for overnight lows. You cast that vision forward. On the chart, you're expecting it's going to deliver. Until you're proven wrong, and it's obvious, you keep that vision in mind, how it's reaching towards that relative equal low overnight. Every single candlestick has its place. It has its role in the plot. But not every single candlestick is a supporting actor, and it's not a leading man or a leading woman in the plot. So the market creates this run up and then starts to slowly work lower, then gyrates sideways, moves a little bit lower, gyrates sideways, and it starts looking like a very frustrating type of profile. So when I see price doing this, I'm going to look for leading men or leading women candlesticks in the plot. The plot is this booger is going down to take those overnight lows out. Now, every one of these candlesticks in here is just like, so just an extra in the cast. They're not even getting paid to be there. They're just happy to be a part of it. And that's what's being shown here with all these different kind of candlesticks. But what I'm looking for is I'm looking for the candlesticks that have the time in the plot to start pulling forth their best acting. They're going to bring out an Oscar-winning performance. Well, we're going to bring in time now. 950 to 1010 macro. You're familiar with that if you've been watching anything I've been teaching. The market creates this return back into the first presented fair value gap. We anticipate this acting as a premium array. It should repel price or keep it from going in the upper half here. It just comes up, just breezes to the low of it, and then says, no, I'm not interested. No thanks. And then what does it create here? What's that? That's a SIBI. So now that is a leading man or leading woman candlestick. It's going to be impactful. So now we want a supporting actor or candle to come up and show how great of a candlestick this is by it coming up to half of its range. See that? But now, look closely. We're zoomed in. We have a little bit more data on the price action, and we have two relative equal lows. What makes them relative equal? The one to the right is slightly higher than the one to the left. So this is a strong candidate for a raid on that sell side algorithmically. And that's how your eye is supposed to identify it, okay? It's less likely to see that immediate run. Like, for instance, say we were looking at this low and that low. This is not a relative equal low. It's not a high probability. It can eventually trade through it, but not without at least retracing back for an inefficiency above the low. In other words, something going back to the left, either an inefficiency or a short-term high. That's why I'm teaching you and have taught you for years to look for the low that had the slightly higher low to the right. If it looks like this, chances are it's going to have a deeper retracement. It wants an inefficiency premium, or it wants a buy-sell liquidity pool. Price runs up into these highs, and fails to even get back to this old fair value gap. So it's just consolidating. But what you're waiting for is the time for them to perform. But you have to know the plot. The plot is it's running for sell side, and the sell side is determined by overnight lows. So those lows are like that big magnet, and you're casting forth a vision that you're looking for this plot to pan out with Oscar-winning performances by very specific candlesticks at very specific times in the storytelling. During the macro, trades up to the low of the fair value gap. That's first presented fair value gap. Price trades up to consequent encouragement during the same macro. It trades lower. No fair value gap in here except for this little tiny piece right there, which is like nothing. It's like an extra in the cast. Why is this not so important? Because we haven't even broken this low. So that right there is not important to me. If this would have broken down below that, then that would have been much more salient to the plot. But because it hasn't even taken that low out, the fair value gap is just a common gap.
I love this analogy of candles being actors in a movie. Some candles are more important than others, like this one here, and these candles are confirming the fair value gap. Now, I've always looked at these like if price should keep going lower, then we should not break above this swing high because these candles supported the bearish fair value gap. In this example, you can see that the retracement does not break this high, but that's not always going to be the case.
So we had the run on minor sell side liquidity there, and then we retrace back up into the range. Range. What's the range? See that price action right there? From the premium array it reacted to the new sell side low that was taken right here, that created that low and then started retracing. That is how you're defining your range. What is that? It's the first presented fair value gap that formed after 9:30. And it's in the direction that the plot is. Sell side is going to be the target. It's going to be the draw. So we want to see this used like it does it here. Sell off. And because it can't even get into the upper portion or even trade back to the consequent encouragement of the first presented fair value gap, it's exceedingly weak. So all this in here is making it harder for someone that doesn't understand that. So the range is this right there. Now, think for a moment. Look at the midpoint. See that right there? There's a lot of price action being offered in that same range. That equilibrium price point has to have an inefficiency. Inside that range, we can see, there you go. What's that? That's a SIBI. If I take that SIBI and extend it through, look at the magic that happens. See that? Ain't that amazing? No advantage, like I said. So by having this, I'm going to take that little range box off. We can anticipate how far that shallow run below that minor sell side is going to trade right back up. And the bodies are saying, yeah, the story is still the same. All this was a plot twist. And it's causing people that don't know what they're doing to think that it's made a short-term low and it's going to rally up. But it's only going to go up to where I say it's going to go with this fair value gap. That's the equilibrium inside of this range during time distortion. That's a lot. But the veteran students knows exactly what that implies, but now you're learning how to use it. We enter another time period where price reaches up into that old SIBI. And because I'm not trading supply and demand as the folks up there use it, I'm cutting through candles. I'm going back to that one. Why did I choose that one? Because it's in the middle of the equilibrium of that range, high and low, defined by liquidity and my IPDA arrays.
So this feels kind of familiar, but at the same time kind of new. He might have talked about fair value gaps at equilibrium and I just forgot, but this is definitely something I will want to remember and use myself. However, defining the range here, this is going to be something that I think is going to be pretty difficult for me. I know he makes it look easy, but this is going to be something that I consistently work on when practicing reading the chart.
Now, the bodies come up to the high of that fair value gap there, and then we leave it and then look at the bodies. They stay right at the lower quadrant of it. It's not highlighted, but you can do this on your own chart. The wick goes almost to the top, but the bodies stay in the lower half. That's the signature that you know it's getting ready to start falling. This dive down in here, this last little piece of the run that takes us down into that overnight low. We had this small little gap after leaving this one. It comes up, trades into it. The bodies don't even come to the high of it. The wicks respect it. We drop down, consequent encroachment on that wick, and then we start to move lower. And we're going sideways, until we get to a macro time. That's not highlighted here. You do it on your chart. At 10:50 to 11:10, it's going to displace. Where's it going to displace? First run is here, so you cast forth a vision. Time for the market to run. Where? Lower. What's the nearby sell side? There. Where's it been drawing to, and where's the original vision that you cast forth over the chart? Overnight lows. It dives down. You have long stretched out black limousines running down to the 654 club below that low. When you see price action through this lens of creating a narrative, a plot, why it should do this, why it shouldn't do that, what candles are standing out? They're leading men or leading women candlesticks in the storyline. They're going to have a major role. And the candles that use them later on, like this over here, these are supporting actors. The supporting actor is saying, yes, this person, if it were a person, we're going to personify the candlestick. This actress is falling apart. And we're going to show that she's falling apart because we can't overtake the high of that. And we're stopping right in the middle with the bodies. And then we have more supporting actors over here with these candlesticks, only go up to half of it. So the plot's not changed. They didn't change the algorithm. Everything's the same, just the date's different. That's it. That's all it is. This here is the same thing that is. We're in a range, consolidation. This old city is a reclaimed fair value gap. It's being utilized here, but notice it only starts to displace lower when we enter the macro time that supposedly doesn't exist. I see your comments, guys. And they're very amusing too, by the way. We run lower to take that low, and then we take that original overnight sell side out there. But wait, there's more. Let's look at the afternoon. Now, I teach don't trade between 11:30 in the morning to 1:30 in the afternoon if you're brand new, because you're going to get chopped up. That lunch macro is sneaky. And if you don't know what you're doing, it can hurt you. So the way you avoid it is simply don't do anything. Wait until 1:30 in the afternoon, Eastern time. Come back to your charts and watch how price sets up the PM session. Well, wouldn't you know it? Market rallies up, approaches what, first percent fair value gap again, and something else we'll look at in a minute. That's foreshadowing. ICT version. Why are you whispering, dude? You're creepy. Right in here, you can see we have minor sell side. It's high probability, relative equal lows. Why? Because the lows to the right of that one are slightly higher. We have an old low of the day formed at AM session. So you have AM session lows during regular trading hours. So that's regular trading hours, AM session low, sell side. You don't have to be all this wordy, but for teaching purposes, I'm differentiating it so that way you know. I always have a textbook response to people when they ask me questions because I want you to know it the right way. I want you to learn it properly. The market sells off from here. Where should it sell off to? Sell side here, and then you want to see speed. If it can get below these lows, if it can speed up and start having elongated candlesticks to the downside, then you know it's likely to do what? Reach for that sell side there. So that's the reason why I teach partials. There's a lot of people out there say, don't take partials. You shouldn't do partials. Okay. Are you rich? Are you retired? Because if you're not, don't give advice. So these lows here are perfect partials, perfect candidates to take a partial if you're shorting up here. This is an inversion fair value gap because it's the last major displacement on the upside before it hits a premium array and then it folds over. That right there is your model 2022, just on a very small time frame. And it's the first fair value gap after the rotation over.
So I normally don't look at the PM session. The time just doesn't work out with my personal schedule, but I do know a common profile is lunchtime retracement and then continuation of the morning move, as you can see in this example. So why is this rotation over here and not this one when this high was taken? Well, remember, we need to hit a higher time frame key level. Now he's going to tell you what key level we hit in a little bit, but that's why we used this fair value gap, because this was the first fair value gap after hitting that key level. Also, real quick, I just noticed that if you extend this fair value gap all the way through, it's going to overlap with the upper half of this inversion fair value gap. I don't know if that's significant or not, just something I noticed.
So the market drops aggressively after taking that low out and then clears the AM session regular trading hours low and just dives lower. Moving forward and offering the remainder of the day, you can see inversion fair value gap, uses the consequent encouragement there, sells off. Fair value gap there, use that, sell it off. Consolidation. John Murphy would love to see this highlighted on social media. It's a perfect bearish pennant. They occur sometimes, sometimes they're there. Breaks lower and then just fizzles out into the low going into the close of the day. Now, why did this run up here like that and then sell off? What makes that happen? And if you're looking at just simply 1 minute charts or 5 minute charts or 15-minute charts or 1 hour charts, you're not going to get what you need. You have to have a proper top-down analysis, and you have to at least consider the daily chart. If you aren't at least conferring with the daily chart in your trading, you are trading blind. I don't care if you're making money. I don't care if you're getting hot hands in the last few weeks or months or whatever. If you're not looking at the daily chart, eventually the inevitable is going to come. So how will we use that information? What are we looking for? Oh, here's the daily chart. And I just recently, in 2025, released another PDA array. It's the suspension block. It's an inefficiency. Now, normally, folks would look at this candlestick's low to that candlestick's high and say that's an inefficiency. Well, yes, there's an inefficiency there, yes. But the real inefficiency is framed by the volume imbalance down here and that volume imbalance there. So this candlestick's open and that candlestick's close. That's what's being shown here. So this candle's what's being highlighted. It's the ICT suspension block. It's another form of buy side imbalance, sell side efficiency. It is not, not a quote unquote liquidity void. Okay. A liquidity void is when there's no trading at all. That's an actual gap. There's no buying and selling in there. That's a liquidity void. There's been no liquidity offered at all. That's the only void that exists in price. So there's your suspension block. Okay. Now by having this information on your chart, let's go back down into that same chart. Wow. What you're saying, ICT, is the market went down, couldn't even get to the upper quadrant of it, and consolidated. And then it retraced right back up towards the first fair value gap, and it's the high of that suspension block on the daily chart. That's a premium array. What do you think a premium array on a daily chart is going to do to price if it's bearish? Send it lower. Do you think it went lower off of that? Sure it did. But a lot of you probably were caught off guard because you're not looking for things on the daily chart. You're looking at 1 minute charts and 15-second charts and 5-second charts, 1 second chart, little squiggly patterns. Trying to come up with something, trying to invent something, instead of just simply using this stuff that's been handed to you for free. Cast forth a vision. Where's price at now? What is it permissible? Is it allowed to go to this high, to this inefficiency? Is it working in the upper half of a inefficiency above price while still being bearish? Is it respecting only the lower half of that? That's indicating bearishness. It's weak. It's going to send price lower. All these factors have to be weighed in the balance.
Now, I know he just rapid fired over a lot of things just now. If you're a veteran, you've been studying a lot, maybe you can relate to what he's saying. But if you're new, don't worry if you don't get everything just yet. It will come with experience. If you want to accelerate your learning, you need to practice, and practice with backtesting. Go through the last year, day by day, and try to read price. Stick with the 7 a.m. to 12 p.m. time frame or the afternoon session, whichever one you're looking to trade. Look at the liquidity. Look at the PDA arrays that you know and divide each PDA array by half and see what you observe and take notes. Have patience. It will take time. Don't think you can just pick it up and understand everything on your first attempt.
Notice what it's done here at 1:30. It creates that little run up to the top of that daily suspension block. That right there is this high of that candlestick's open. So that little segment inside that candlestick is price simply going right here, going up to go down. That's all it is. And when you anticipate when prices are going to likely do these types of things and gravitate towards, well, let's go back up to the daily chart. Half of this range here, that's this blue line here. So up here, upper quadrant, that's reasonable because it would be going below that low. If there's sell side below that, try to reach to the upper quadrant of that daily suspension block. It hits it, and look what it does. It hits it and slices through it. So it means what? It's likely going to reach for half of that range that's down here. And it just fell short of it there. We have the new week opening gap presently today, formed there. But that's a nice drop off. Is there a narrative that you can exploit behind what price is doing at the moment? If you can't build a narrative as why price is doing what you think it should do to find a price run to profit off of, if you can't make that make sense in price action, chances are you're forcing a setup, you're gambling, and you're going to go on tilt. That means you're simply bored or you're being impatient and you're not following a model. You're gambling.
All right, so that's gonna do it this time, guys. Hopefully this was insightful to you. The main idea that I got out of it is that narrative is more important than market structure. Narrative is what allows you to build a story and see where price is likely to go to next, thereby predicting the market. So if you like this kind of video, please give this video a thumbs up and make sure you subscribe and turn on notifications so you'll know as soon as the next one drops. But until next time, guys, safe trading.